Hey everyone, welcome back to Corporate Decoder, the place where we decipher the nitty-gritty of business. And believe me, this Dominari Holdings report has some serious moves to unpack, almost like a financial chess match where everything is a gambit. Today we're diving headfirst into Dominari Holdings Inc.'s latest quarterly report, their Form 10Q for the period ending June 30, 2025. Think of this as their mid-year financial checkup, and let's see if they're getting a clean bill of health or there are some red flags waving in the breeze. First off, let's get a handle on the sheer size of the company. As of early August 2025, they had over 15 million shares of common stock out there, which tells us they're a publicly traded entity with a good number of owners. Now let's jump straight into the heart of this report, the financial statements. This is where the real story of Dominari Holdings' performance unfolds. Looking at their balance sheet, a key indicator of financial health is their cash. As of June 30, 2025, Dominari Holdings had about $9.5 million in cash and cash equivalents. That's up from around $4.1 million at the end of 2024. So they've clearly been building up their cash reserves, which is generally a positive sign. They also had a significant chunk of their assets in marketable securities, close to $18.8 million. This suggests they are actively investing and managing their available funds beyond just basic cash. And then there's the $31 million in receivables from their clearing brokers. This amount is quite substantial, and it's more than doubled from the end of last year. This line item is important because it shows money owed to them for services rendered, and a big jump here could indicate increased business activity through their brokerage arm. All these current assets, the cash, the securities, the receivables add up to over $60 million. That means they have a lot of readily available resources. When we look at everything, all their assets, both current and long-term, they reach over $109 million. That's a significant increase from December 2024, when their total assets were a little over $47 million. This growth is driven heavily by increases in their investments and receivables. On the other side of the coin, we have liabilities. Their total liabilities are a little over $20 million. While this has also increased from the previous year, it's still considerably less than their total assets, which is a good thing. Now, let's talk about what makes up the ownership side of the company, the stockholders' equity. Their additional paid-in capital, which is the money investors have put in beyond the par value of the stock, is a massive $344 million. This shows a huge amount of investment from shareholders. However, they still carry an accumulated deficit of over $246 million. This means that cumulatively, the company has spent more money than it has earned over its lifetime. It's not uncommon for growth-focused companies, especially those in financial services or tech, to have a deficit while they're investing heavily in expansion. Despite the deficit, their total stockholders' equity stands at nearly $89 million, a big jump from about $40 million at the end of 2024. This substantial increase in equity from their financing activities, like issuing new stock and warrants, really boosted their shareholder value on paper. Moving on to how they're actually performing, let's look at their revenue and earnings. For the 3 months ending June 30, 2025, Dominari brought in over $34 million in revenue. That's a huge leap from just over $6 million during the same period in 2024. Their 6-month revenue also shot up to over $42 million from about $7.5 million. This massive revenue growth is a really strong indicator that their financial services business is really taking off. But as revenue goes up, so do expenses. Their total operating expenses for the 3 months were around $53.5 million, a significant increase from about $8.9 million in the prior year. For the 6 months, expenses jumped to nearly $94 million from about $13 million. And here's where it gets interesting. For the 3 months ending June 30, 2025, they reported a net income attributable to common stockholders of about $16.6 million. This is a dramatic turnaround from a net loss of over $6 million in the same period of 2024 to about $15.8 million in 2024 to about $15.8 million in 2025, with the third quarter profits offsetting the first quarter losses to some extent. This translated into earnings per share of 120 yen for the 3 months ending June 30th, a far cry from the loss of 1.0 in the previous year. For the 6 months, the loss per share was 124 compared to 192 won, compared to 192 won, compared to 192 won, compared to $12.9024. Let's dig a bit deeper into the 6-month figures on the cash flow statement. They started with a net loss of over $14 million. This is adjusted for various non-cash items and changes in their assets and liabilities. A striking item here is the stock-based compensation, a whopping $54.8 million for the 6 months ending June 30, 2025. This is a massive increase from just under $1 million in the same period in 2024. This indicates they've been using stock as a significant incentive, likely for new hires or key personnel as part of their expansion. The changes in their operating assets and liabilities show some notable movements. The receivable from clearing brokers decreased by over $13 million. This means money previously owed to them from brokers was collected. On the flip side, accrued commissions went up by almost $11 million. This signifies that they've earned commissions that haven't been paid out yet, which is a good sign for future cash flow. Despite the large net loss, these adjustments and changes in working capital resulted in a positive cash flow from operating activities of about $82,000 for the 6 months. This is a big swing from a negative cash flow of over $7 million in the same period last year. It shows that even with the reported losses, their core operations are generating more cash. In terms of investing activities, they used about $4.3 million. This was mainly due to purchasing marketable securities worth over $13 million, but they also sold securities bringing in over $6.8 million and collected over $1 million from notes receivable. Financing activities provided a positive $8.8 million. This was largely driven by issuing new stock, bringing in cash from warrant exercises, although they did pay out dividends of over $7 million. To understand these financials, we need to look at what Dominari Holdings actually does. Their business is evolving. They've been actively expanding into financial services through subsidiaries like Dominari Financial and Dominari Securities. They acquired a broker-dealer and investment advisor and are forming new ventures. The mention of American Ventures Management and American Ventures Management and American Ventures IM LLC on June 17, 2025 shows they are continuing to build out their investment management capabilities. It's important to note that they mentioned no material changes to their accounting policies. This means the way they're reporting their financial results is consistent with what they've told us before. When they talk about revenue, they are following strict accounting rules called ASC 606. They earn money from underwriting services, which is essentially helping companies raise money by selling their stocks or bonds. They also do private placement agent services, which is similar but often for private companies. They recognize this revenue on the trade date, which is the day a deal is agreed upon because that's when the client gets control of the investment. Commissions are what they make by just handling trades for customers. They earn this the moment a trade happens on the trade date. Then there are account advisory and management fees. These are recognized over time, meaning they earn them gradually as they provide ongoing services, not all at once. This is typical for wealth management where they earn a percentage of the assets they manage. Dominari is also heavily invested in other companies referred to as long-term equity investments. As of June 30, 2025, they had investments in companies like Kona Health, Revere Master SPV, Yunker Industries, Payword, and quite a few others. A notable one is their investment in American Bitcoin Corp. They actually increased their stake, and this investment alone saw its value jump from around $360,000 to $32 million as of June 30, 2025. This massive gain on their American Bitcoin Corp investment is a huge driver behind their overall positive results for the quarter. They also mention a potential merger for American Bitcoin Corp investment is a huge driver behind their overall positive results for the quarter. They also mention a potential merger for American Bitcoin Corp investment is a huge driver behind their overall positive results for the quarter. They also mention a potential merger for massive gain on their American Bitcoin Corp investment is a huge driver behind their overall positive results for the quarter. They also mention a potential merger for American Bitcoin Corp that could see it trading on NASDAQ. Overall, the changes in the value of these long-term investments are huge. They saw a $31.7 million increase in their value in just the first half of the year. This shows how much their portfolio of other companies has grown in value. This section details how their ownership structure works, particularly with preferred stock and warrants. They've recently issued a lot more common stock. In February 2025 alone, they sold registered and unregistered shares, raising about $13.5 million. Then they also issued a significant number of shares as part of advisory agreements, valuing those at over $20 million. They also granted and issued a lot of stock and stock options to employees and advisors. For example, 50,000 shares were issued under their equity incentive plan, and over 500,000 shares were granted to key executives. The total stock-based compensation, including options, reached over $54 million for the 6 months of 2025, which is a massive commitment. Dominari operates in two main segments: Dominari Financial, which handles brokerage and transactional services, and Legacy Aikido, which manages their older investment holdings. In the 3 months ending June 30, 2025, Dominari Financial brought in over $34 million in revenue, while Legacy Aikido had no revenue in that period. And for the first 6 months of 2025, Dominari Financial generated over $42 million in revenue. The Legacy Aikido segment, however, accounts for the bulk of the losses, with over $53 million in operating costs and a net loss of over $20 million. This clearly shows that the financial services business is where the action and the potential for growth are happening, while the older biotech segment is a drain on resources. They've flagged material weaknesses in their internal controls. These include issues like not having enough staff to close their books on time, problems with accounting for certain investments, lack of proper separation of duties, and general IT control issues. In simpler terms, their financial reporting process isn't as robust as it should be, and management admits these controls were not effective. This is a serious concern, suggesting that there's a higher risk of errors or misstatements not being caught. While they've improved and continue to work on this, it's something investors should keep a close eye on. So what's the verdict on Dominari Holdings after this quarter? On one hand, the revenue surge in their financial services segment, the significant increase in cash and equity, and the massive unrealized gains from their investments, particularly in American Bitcoin Corp, paint a picture of a company on the rise. They've clearly executed well on their strategy to pivot towards financial services, and the growth is undeniable. The huge stock compensation also shows a strong commitment to incentivizing growth. However, we can't ignore that massive accumulated deficit and those serious material weaknesses in their internal controls. While the short-term numbers look great, the underlying operational control issues are a significant risk. It suggests a company growing very fast, perhaps too fast, for its internal systems to keep up reliably. The big gains from investments like American Bitcoin Corp are fantastic, but it also means their performance is heavily reliant on the success of these external investments, which can be volatile. Looking ahead, Dominari Holdings is in an interesting spot. They have the momentum in their core business, but they need to fix those internal control issues to ensure sustainable and reliable growth. If they can do that while continuing to capitalize on their investment portfolio, they could be a significant player. But if those control weaknesses persist, it could lead to bigger problems down the line. What do you think about Dominari Holdings' financial performance and their pivot to financial services? Is the growth sustainable, or are the internal control issues a deal breaker? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into corporate filings. And hey, join our Discord community linked in the description. It's a great place to discuss these kinds of insights and stay ahead of the curve. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.